Lawyers, when was the last time you really looked at your trust account? Not a glance, a deep dive. Even if you think it's fine, hidden warning signs can be lurking in plain sight. If a regulator, auditor, or client spots them first, the consequences can be career-ending. Today we uncover 5 hidden red flags and how to catch them before they become disasters. No on-camera face, just clear steps you can use immediately. Pay attention. The time to fix these is now. Red flag number 1. Client funds not matching ledger balances. Let's dive in. Watch for mismatches between client ledgers and the bank balance. Even a few dollars of unexplained variance is a red flag to regulators. Imagine a $10,000 settlement where a missed $200 fee leaves a $200 gap. If you can't explain it, you may be explaining it to the disciplinary board. Tip: reconcile client ledgers to the trust bank balance monthly. Every client's money should have its own ledger entry you can verify instantly. Those numbers must add up exactly to the total trust balance. Late clearing checks, misapplied deposits, or missed withdrawals create gaps. A $200 unrecorded fee turns $10,000 into $9,800 at the bank, while the ledger still reads $10,000. To auditors, small gaps aren't innocent. They're non-compliance signals. Fix: have a documented process to verify each transaction. Record entries immediately and reconcile discrepancies the same day you find them. Next, unexplained outstanding balances. Small dormant balances can raise big questions in an audit. Action: return, apply, or document why funds remain. Red flag 2. Unexplained outstanding balances sitting in trust after the matter is closed. Money left untouched for months or years looks like neglect to regulators. A $150 check left in trust can trigger questions. Was it abandoned or mishandled? Example: a $300 balance sits for 2 years. During audit, this becomes a red flag. Pro tip: review client ledgers monthly and act. Return, apply, or document. Document your efforts to contact clients and the reason for retaining funds. Red flag 3. Commingling personal and client funds. Even well-intentioned transfers create a loss of transparency. Never use the trust account for firm payroll or operating expenses. Keep only the allowed nominal balance to cover bank fees. Commingling is mixing client funds with your personal or firm money. Once mixed, you lose proof of ownership. Common errors: reimbursements without documentation, early transfers to cover payroll, or mixing retainers with operating funds. Even innocent intentions look bad in an audit. Example: an attorney deposits both retainers and legal fees into trust intending to sort later, then never sorts them. Outcome: discipline for sloppy bookkeeping, not necessarily theft, but the result can be the same. Transparency is everything. Commingling destroys it. Prevention: keep separate accounts, document any permitted transfers, and require approvals. Use software that forces a client fund designation at entry. Exported reports make audits easier and deter mistakes. Next, missing documentation. If there's no paper trail, auditors assume the worst. Every dollar in or out of trust must have a paper trail: deposit slips, invoices, settlement statements. Missing documentation turns legitimate transactions into compliance problems. Example: a $5,000 expense without an invoice becomes unexplainable in an audit. Auditors treat missing paperwork as if the transaction never occurred. Pro tip: scan and store both physical and digital copies with consistent file names and metadata. Action: treat every transaction like evidence, store it securely, and index it. Finally, skipping monthly reconciliations. Reconciling is your safety net. Skip it and you're flying blind. Reconciling matches 3 records: bank statements, client ledgers, and the trust journal. If they don't match exactly, you have a problem. Skipping monthly reconciliations lets errors compound until they're catastrophic. Example: 6 months without reconciles led to thousands in uncorrected errors during an audit. Fix: perform monthly reconciliations and keep the reconciliation reports filed. Use software to automate matching and alert you to exceptions. A dated, signed reconciliation report is your best defense in an audit. Quick recap next. Catch these early and you protect your practice. Recap: 1. Client funds not matching ledgers. 2. Unexplained outstanding balances. 3. Commingling. 4. Missing documentation. 5. Skipping monthly reconciliations. With the right systems and the right help, you can catch these red flags early and stay compliant. At Legal Bookkeeping Online, we help lawyers manage trust accounts with precision so you can sleep easy. Review your ledgers today. If you need help, visit our site. Remember, when it comes to client trust funds, there's no room for error. Thank you for watching.